I typically have a pretty high tolerance for comments made about financial advice and financial advisors in general. We're all made in different shapes and sizes and come from different perspectives and belief systems, so it's okay. But I came across this YouTube video that has almost 30,000 views and a lot of comments, and I just had to say something about it. Let's dive right in and do a true and false analysis on this particular guy's perspectives.
Hi, you guys. I'm Phil Town from Rule Number One Investing. Today, I want to tell you why you don't need a financial advisor to invest your money for you.
As a creator, I would always say that anybody is entitled to their own opinion, right? I can't fault you for that. It's obviously going to be the basis for maybe, some, let's say, lifestyle that you've lived or things you've gone through, experiences you had. All valid. Now, whether they're wrong or right is something totally different, which is the reason why I'm harping on Phil Town today. Phil Town probably won't ever see this video, probably won't ever care about DJH Capital Management and Dominique Henderson, but if he does, I think he should correct some of the statements he makes in this video, just because I think it's a little misleading to a person that has, less knowledge or is looking for information. For somebody to be an authority and to be misleading seems to be somewhat ingenuous. So let's dive into what I had issue with. True or false? All advisors are the same. False. I just said that. We all comes in different shapes and sizes. I come from a different belief system. My upbringing, my training, my experience, my certifications, where I've worked, my client interactions. I mean, I can go on and on and on. And as you can see in this video, if you watch it all the way through, there's this theme that he's trying to basically paint all financial advisors into one corner. I'm not going to give it away right now, but he's talking about a different type of person or professional in the financial advice industry or in the investment management industry, like asset management. He's not really talking about financial advisors that are CFPs. But I think he should make this clear. He doesn't really make this clear in his video because I think what he's trying to do is get you as the watcher of the video to do all of it on your own, which may or may not be the right decision. He needs to give you more facts. Let me give you a case in point. So an asset manager may work for a shop like Fidelity. I have nothing against Fidelity. Let's just use them as an example because everybody knows them pretty much. So an asset manager is going to work for Fidelity. Now, what does this asset manager or fund manager do? Well, Fidelity is a mutual fund company. They take your money in, they pool it together inside of a big vehicle called a mutual fund. And the mutual fund may invest in various different things, but make no mistake about it, there is an asset management team or fund manager team. Let's say that's just one person for simplicity. That fund manager is going to decide how much of Apple or Google to own in the portfolio and how much to sell and whatnot. Now that guy gets paid a salary, and if the performance of the portfolio that he's constructed does well, he usually gets a bonus. Now, I think he's worth his money because he is taking let's say a task that you or I we would have to do if he didn't do it for us. If the fund performs well, he should get rewarded for it. That's not the same thing as me. I'm a financial advisor that charges for advice. There's some financial advisors that charge differently. Maybe they charge at an AUM model. Maybe some do fixed fees. Maybe some do hourly. Some do commissions and get trails. There's all kinds of things. So if you're looking at what he's saying about all financial advisors are the same, that's a very misleading statement. And that's why I'm saying it's false.
Now, I think perhaps this myth has persisted for so long because there's a lot of persistent marketing on behalf of financial advisory firms. They spend billions of dollars a year to convince you of this.
Are tons of money spent on marketing financial services every year? Yes, billions. He's true. This is a true statement here. And I think the overarching theme with that dollars spent for advertising in this particular space is to pretty much make all financial advisors look the same. Because at the end of the day, the industry is more about gathering assets so that they can charge fees on the assets that are gathered. Now, Before you jump to a conclusion and you say, oh, Dominique doesn't like the financial advice industry. I'm part of the financial advice industry. I have been for years now, and that's not exactly what I'm saying. What I'm saying is when you look at the advertising machine, the financial industry looks like the bad guy because they essentially are trying to make a profit. And the only way they make a profit is if they collect your assets and charge you a fee for them. Now, that's not to say that in exchange, you don't get good advice. All the time you don't. And that's why you have to have a rubric for who you work with and what your goals are. That's where the next layer comes in. So, is he correct in saying that, tons of dollars are spent every year on advice or on advertising by the financial advice industry? Yes, that is absolutely true.
But the reality is that investors who manage their own money are often able to perform at least as well, and the bar is quite low there, so at least as well or better than those who work with a financial advisor.
I love this statement. You can perform at least as well as a financial advisor. I think it depends. What are we talking about here? Are we talking about investments only? There's a lot of research that shows that active management, stock picking, market timing, and all that kind of stuff, there's no real correlation except for luck. If you were able to beat the market year after year after year, which nobody's ever been able to do, by the way, but if you were able to do it, there's really no correlation in the empirical data that shows that it's anything more than luck. Well, if that's the case, then that comparison is just off the table, period. I would say, though, that most advisors that I'm in relationship with and most of the clients that come to us are typically looking for more than just investment management. There's so many aspects to your financial life really that are centered around your behaviors around money. And really the financial advisor is designed to come alongside you as a trusted confidant and partner to help you manage the behaviors that will get you to your goals faster. If you just Google Dalbar study, D-A-L-B-A-R, you can see how often the average investor underperforms the market. There is some synergy, there is some value to be gained with the advice and the perspective from someone that has less emotional tie to your outcome so that you can operate in a more rational manner and not make the mistakes that would cause you to lose money in the market or make what I would call a six-figure mistake. So, can you perform at least as well as an advisor? Probably not, especially when you consider that there's more that meets the eye in your portfolio than just your investments.
Financial advisors charge you regardless of whether or not they make you any money. The fees that financial advisors charge are not based on the returns they deliver, but rather they're based on how much money you invest. And that means that even if they end up losing the money that you entrust with them, you're still going to get a bill for their services.
Here's another statement I love. Fees that financial advisors charge are based on how much you invest. No, not always. There are so many different models. In the model that I gave you at first with the Fidelity Manager, he's got a salary, he's got a commission and or a bonus based on performance of the funds that he's managing. But that's a whole different structure than somebody like myself or somebody that's working in a smaller boutique firm. Usually somebody that's working in a firm is going to be incentivized by salary. But let's talk about the business owner because that's probably who he's talking about as the person that's in charge. Well, there's so many different ways. There could be assets under management or assets under advisement. They're both called the same thing. Whereas you bring that particular advisor $1 million, they charge you 1% of the fees. So that's $10,000 per year, usually charged quarterly. There's also fixed fee retainer models or fixed fee and or retainer where they charge you a flat fee, maybe a fee for the investment plan that they do, and every month or every quarter or every year, however they decide to charge, they charge you X amount of dollars based on the advice or the plan or the strategy that you have undertaken. Then you have commission where people sell you products and the company that they're representing when they sell that product pays them a trail or a commission for selling that. This is very common in life insurance. And then you got the hourly model that's more like, maybe like a lawyer would charge you where they charge you just for the time that you spend with them. So I would gather that he's trying to hint that financial advisors are motivated by fees and how much they can collect in fees from you by managing your money. And that's not all financial advisors. The Fidelity guy and the Fidelity as a whole, that company, is motivated by gathering assets because they charge fees on that. And the more that they can put you in their Fidelity funds that charge an expense ratio or a management fee, the more money that they make. Now, again, they're in profit. So, that's neither here nor there in this particular discussion. The point is if you're working with a personal financial advisor and you're not calling up Fidelity or buying their funds, largely the statement he's making does not apply to you. You would need to negotiate or find a financial advisor that you can work with, and the fee arrangement is okay with you. I think the best thing about this particular industry, and when you want to work with a financial advisor, is that you can just have a discussion. And I would say a red flag is if they hide how they're compensated. If they hide how they're compensated, you probably don't want to work with them. If you're working with somebody that's upfront with their fees, they let you know that, hey, this is how I get paid, and you pay me, quarterly or however it is. I think that's okay, and you can work with that. But when it's hidden and there's products and all these different things where they have different incentive and different structures, compensation structures for how they manage your money, that's where you need to ask some more questions. So the gist of his statement, I believe, is pointed at, again, the industry as a whole versus the individual. Now, Philtown, if you're watching this, I love you, buddy. I know what you're doing. I applaud your hustle. I just don't agree with everything you say, and so we're gonna have to agree to disagree. If you're watching this right now and you're on my channel, make sure you check out the video in the cards because I have talked about all types of things that you need to know before you're working with a financial advisor. I have also created a 20 myths about financial advice, which I will have down in the show notes for you to download for free, get your copy, and become an informed investor. Don't just listen to what I say or what Phil Town says. Do your own research. We'll talk to you later. Bye-bye.